So we got a ton of questions over the weekend about longer duration, poor man's cover calls or zebra type setups, just a way to get some leverage on a long stock position or a similar type of position. So we're going to walk through those today with a quick little segment here. So just quickly, the difference between a cover call and a poor man's cover call. So with a cover call, you're obviously going to have a higher max profit potential. That's because you don't have any drag of extrinsic value that you're buying in your long option. Assuming you're selling the same short option, you're going to have a net higher extrinsic value on your cover call position versus a poor man's cover call position. So it does have a little bit higher profit potential. The caveat is that you're going to have a lower return on capital because you have to put up the capital to hold a full stock position. And a lot of times, one of the big considerations is account type. If you're in a cash or IRA type account, that's a significant amount of capital to put up relative to a margin account where you already get that, little bit of leverage on a stock position. It's still going to be less more expensive to hold stock than it would most 80 or 90 delta calls as a poor man's cover call, but it's still a consideration in that you typically use a little bit more capital to hold just a long stock position. Of course, with cover calls, you got no expiration and you can roll these calls as many times as you want without having to rebuy the long option, rebuy extrinsic value. That is definitely a positive of the cover call versus a poor man's cover call, which does have a set time limit to it. But of course, you can, extend that duration further by rolling. But just from the onset of opening the positions, there is a cap to the amount of time there. One of the things to consider with these two is that your cover call position, it's pretty much a static delta position. The change in delta is only coming from that short option, which is going to reduce the overall delta of your position. Whereas with a poor man's cover call or a zebra or a leap option, something like that, your delta is a lot more dynamic in that if you do get a move against you, like if you're doing a cover call or a poor man's cover call and the stock goes down, your long option is going to lose delta. So you synthetically get less directional as you continue to be wrong, which is the opposite of what happens with a covered call because you're statically long 100 deltas. So your delta does change more dynamically with a poor man's cover call.
Indeed. And of course, with a covered call, you have a little bit more flexibility just because the shares don't expire as long as the stock stays in existence. So that poor man's covered call is really time dependent. And that I think is the biggest thing to keep your mind on. If you're trying to do really long-term stuff, covered call and poor man's covered call are going to have a similar buying power reduction and things like that.
Yeah, the longer, and this is with any option position, the longer the duration, the more it tends to, the more the leverage kind of gets taken out, right? The leverage of an option is, and really all the Greeks and all the, everything about options is really structured in that 0 to 100-day time frame, let's say. After that, it's much less about the Greeks and the leverage and more about the time value of that position, right? So when you have a longer duration option, it's going to be more like stock in that its value is just time-based. Stock doesn't have any volatility value or any, decay value to it. That same application applies to options as well. All right, so another way that you can get into a poor man's cover call / a longer duration trade is with an in the money versus an out of the money diagonal / poor man's cover call. They're pretty much the same position. So with an in the money diagonal spread, we call that the poor man's cover call or poor man's cover put. You're going to have a high delta long option somewhere in the 80 to 90 range or a little bit less if you want to, but 70 to 90, let's say, and then you're selling a 20 to 30 delta short option. Net, you're going to have somewhere between 40 and 70 long deltas on that position. An out of the money diagonal, you're going to set up with a 50 delta long option or maybe a 40, 45, something like that. And then you're selling a 20 or 30 delta short option against it. So the comparison of the delta here on entry, poor man's cover call, much more like a standard cover call. You're going to have somewhere around 60 deltas, 50, 60 long deltas. Out of the money diagonal, you'll have somewhere around 15 to 20 long delta on the opening of that position. Now, the delta of these positions with the in the money position, it's going to be basically static, right? So even if you get a move to the upside, of course, your long option is going to gain delta. You're going to get more long delta, but your short option is also going to increase in delta. So the net effect is very minimal, right? You might go from a 60 delta to a 62 delta overall in that position. With the out of the money diagonal, you're going to go from a 15 or 20 delta to maybe a 40 or 50 delta net delta position. So you get much more dynamic deltas if you're directionally correct, which comes from that high positive gamma aspect that comes with the out of the money diagonal spread. So it's a position, if you're looking to do long term, if you take both of these positions, the poor man's cover call from my perspective is a little bit more conservative in that your delta is a little bit more static and you're more directional. Whereas the diagonal spread is a little bit higher risk in terms of the position going to zero, but also a higher reward in that it's going to be cheaper cost. You have that higher delta potential if you're correct on your assumptions. So, that's kind of the trade-off here. And from a Greek perspective, you're not going to have a ton of theta on either of these positions. The poor man's cover call, you might have a flat to slightly positive theta decay because, of course, you're buying some extrinsic value in the long option. So you're going to have to account for that with what you're selling. With the out of the money diagonal, you might be flat theta in the short term, but ultimately the bulk of your position is long premium and long extrinsic value. So you're going to have negative decay at some point. Vega, I would say they're pretty flat Vega, both of them, but from a longer duration out of the money diagonal, if you're going something like, more like a leap option, you'll definitely have a pretty high volatility component to your position because that long option's further out in time. Of course, gamma, that's probably the big thing that comes into play here, and the cost. Poor man's cover call going to be expensive, out of the money diagonal going to be cheap relative.
Yep. And with the out of the money diagonal being long term, that Vega comes into play if those back months really expand in a big way. Where when you initially set up the trade, you're much more exposed to time value. But if something crazy changes, like if SPY, has a big sell-off and implied volatility goes from 20% to 35%, that's going to have a huge impact on your long options extrinsic value.
Yeah, and it's also about realized volatility, right? So with your in the money long option, of course, realized volatility in your direction is going to help, but it's just helping via delta. It's not changing the inputs of your option price. If you have an out of the money long option and out of the money call diagonal spread, and you get realized volatility to the upside, you're going to see that options volatility increase as well. It's going to get closer at the money. It gets to be a bigger position. That's why, the call that's in the money and the stock goes up $5, you make that $5 because it's basically all delta. If you have the out of the money 35 delta call and the stock goes up 5 delta and that call is now 50 delta, you're not only making that $5, you might make $7 or $8 because that move is much more than just the delta of that option position. It's changes in volatility. It's the changes in the delta of that option via the gamma that increases it. Because you go from a 35 delta to a 55 delta or 50 delta.
Mm-hmm.
All right, so longer term poor man's cover call, longer duration poor man's cover call would set up similar to a normal cover call with the long option being as far out as possible. And, think of this as just the duration you want to be long stock for, right? So, there's not going to be a difference in terms of if you're looking at like an 80 to 90 delta option, there's not going to be a ton of difference in the extrinsic value of that same sort of delta further out in time, but it is going to be a difference in raw value of that option. It's going to be more expensive the further you go out in time. So you have to keep that into consideration. You just want to get as little extrinsic value as possible if you want that synthetic stock position in that 80 to 90 delta. For the short option, generally we go in the 40 to 50 days till expiration range. That's just our standard setup for anything that we're trying to trade per se. We go to the roughly 20, 30 delta. This depends on how directional you want to be. So if you're really bullish on this product and you want to, get a leveraged long position, you buy the 80 or 90 delta call, you might want to sell a 10 or 15 delta call against it in the shorter duration. That's totally fine. It depends on how directional you want to be. The big considerations here are going to be that, of course, you miss out on any dividends. So if this is a stock that pays a sizable dividend, if you're looking at this over multiple year time frame or even a year time frame, and the stock pays, 6% or 5% or 4% dividend, that's definitely something that you should take into consideration, because over a long period of time, that is worthwhile. I think for our application, the biggest thing to consider is just the capital requirement used on these positions. And this is more so applicable to what account type you're in, right? So in a cash or an IRA account, you're almost always going to have more leverage on the option versus the stock. Like when you buy a stock in an IRA or cash account, it's cash secured, so you're putting up the full notional value. There's no avoiding that. With a poor man's covered call, you'll definitely be using less capital to get that same amount or similar amount of delta. When you get when you're in a margin account, you get that added leverage with a stock position, and this goes with our conversations on zebras as well. There's going to be a point, and it's going to differ between stock and the price of the stock as well. But there's going to be a point where the leverage you get on using a in-the-money option, the cost of that option is going to be more than what it would cost you just to hold the outright stock. So consider that when you're entering these positions is, there is going to be a point where just buying the stock outright is going to be more cost effective than buying a 80 or 90 delta long option.
Indeed. And I think really that cash versus margin versus IRA is going to be the reason why you might choose one over the other.
Yeah.
In a margin account, like we said before, the longer term positions like this, you diminish the buying power efficiency aspect of it, because the further out in time you go, the more expensive a poor man's conversion call is going to be, which is going to align. It's going to get closer to aligning with just being long stock at a 50% buying power requirement relative to notional value exposure in a margin account.
Yeah.
Cool.